Hello and welcome back to another video. Today we're going to be looking at bonds and I'm going to be explaining what they are, the different types we can get, as well as all the benefits and disadvantages. So make sure you watch all the way to the end so you don't miss any important details. So to start with, what are they? Bonds are financial instruments that represent a loan made by an investor to a borrower, and that could be a corporation or a government. In essence, a bond is an IOU that can be traded in the financial markets. When an entity issues a bond, it details the term of the loan and its payments. This typically involves two types of payment by the borrower to the holder of the bond. There's a final payment when the bond matures, and there's a stream of smaller payments, usually twice a year, known as coupons. And these are a fixed percentage of the final maturity payment. You can think of the large sum at maturity as the repayment of the original loan, and the coupon payment as interest. Bonds are used by various entities to raise funds. Governments may issue bonds to fund infrastructure projects or sudden expenses like war. Corporations often issue bonds to grow their business, buy property and equipment, undertake profitable projects, or hire employees. Bonds are also known by different names in different countries. For example, in the UK, government bonds are referred to as gilt-edged securities or just gilts. In the US, they are treasuries. In Germany, they are bunds. And in Japan, they are JGBs. So are there different types of bonds? To start with, there are corporate bonds. These are fixed income securities issued by corporations to finance their operations or expansions. The risk and return of corporate bonds varies widely, often reflecting the issuing company's creditworthiness. Then you have treasury bonds. These are generally long-term investments issued by the US government. They have a maturity of 10, 20 or even 30 years, and these types of bonds are backed by the government of the United States and therefore are often regarded as a safe investment option. Next, we have municipal bonds, and these are issued by states, cities, countries, and other government entities to fund public projects such as the construction of schools, hospitals, highways, sewers, and universities. Then we have agency bonds. These are issued by government-affiliated organisations such as Fannie Mae or Freddie Mac. And then we have saving bonds. These are issued by the US government and are fully backed by it. They're non-transferable, which means they cannot be sold to anyone else. And there are also some other types of bonds such as foreign bonds, junk bonds, and also convertible bonds. So what are the benefits? To start with, income generation. Bonds tend to offer the highest and most stable cash streams, providing a predictable stream of income. It also can be good for diversification. Bonds can contribute an element of stability to almost any diversified portfolio. They perform well when stocks are declining, as interest rates fall and bond prices rise. It's also good for capital preservation. Bonds are generally less volatile and less risky than stocks. If capital preservation is your primary goal, then a bond from a stable government is your best bet. There's also predictable returns. When held to maturity, bonds can offer more stable and consistent returns. And finally, there's tax advantages. Certain types of bonds, like municipal bonds, offer tax-free interest at the federal level. And if you own a municipal bond issued by the state where you live, it's tax-free at the state level as well. So what are some of the disadvantages? To start with, there's interest rate risk. The first thing a bond buyer should understand is the inverse relationship between interest rates and bond prices. As interest rates fall, bond prices rise. Conversely, when interest rates rise, bond prices tend to fall. There's also reinvestment risk. There is the risk of having to reinvest proceeds at a lower rate than what the funds were previously earning. There's also inflation risk. When inflation increases dramatically, bonds can have a negative rate of return. And finally, there's a credit risk. Corporate bonds depend on the issuer's ability to repay the debt, so there is always the possibility of default of payment. So this has been my video explaining how bonds work. Hopefully now that you've watched this video, you understand everything you need to know about bonds, and you can use this video to help you in the future when investing in bonds. So I hope you found this video helpful, and thanks for watching.